The banking world is one big mystery, and we think there is an infinite money glitch waiting to be uncovered. Ever pondered over the seemingly boundless wealth of banks? It's not just about stacks of bills in secure vaults, but a captivating digital dimension where the numbers on screens wield incredible influence. But hold on to your financial hats. As we delve into this enigmatic world, we'll encounter the intricate concept of fractional reserve banking. This is where the plot thickens. The financial landscape isn't just about tangible cash, it's a dance between physical currency and the digital wizardry of assets. Therefore, get ready for a riveting journey that demystifies the secrets behind how banks juggle between the tangible and the virtual, and how these maneuvers play a crucial role in shaping your financial reality. So buckle up as we navigate the twists and turns of banking's best-kept secrets. This is the Triple E Show, where we cover mostly economics, engineering, and energy. Fractional reserve banking explained. Have you ever wondered how banks can lend so much more money than they seem to have? The answer lies in a fascinating concept known as fractional reserve banking. This ingenious system is the cornerstone of modern banking and the magic behind what we're calling the infinite money glitch. At its core, fractional reserve banking is a balancing act. It's a method where banks only maintain a fraction of their total deposits as actual cash in reserve, while the majority is used for lending out to others. This approach may seem precarious at first glance, but it's a well-oiled machine that powers our economy. Let's break it down. When you deposit money into a bank, the bank doesn't just stash all your cash in a vault. Instead, it keeps a small percentage, say 10%, and puts the rest to work. The bank lends this money to other customers for various purposes, like buying a house, starting a business, or buying a car. This lending is not just an act of generosity. It's the main way banks make their money, through the interest they charge on these loans. The amount of money banks is required to keep in their vaults isn't set in stone. It's like a rule book, and each bank has its own chapter. These rules are made by the big shots in charge, the laws of the land, the lawmakers, and guess what? They keep tweaking these rules, depending on different factors. It's like a never-ending story. Now, here's the twist. The percentage of money a bank has to keep isn't the same everywhere. It's like a banking adventure where the rules change from one part of the country to another. And that's not all, my friend. The type of banking tricks they play also matters. Different types of banking instruments have different rules. It's like having different sets of rules for playing different games. So yeah, the percentage game in the banking world is a bit like a puzzle. You've got laws, regions, and types of banking instruments all mixed in. It's a dynamic world, always changing, and it keeps everyone on their toes. That's the beauty, or maybe the challenge of banking, a bit of a rulebook riddle that keeps things interesting. We'll explore the reserve ratios of different countries later, and find out if anyone has unlocked the real infinite money glitch. The ability to loan out everything in the bank without a requirement to keep any reserves. As a matter of fact, yes. And you won't be able to guess who it is. But first, let's find out why do we want a fractional system by exploring the pros and cons. Alright, imagine you have a special wallet where you keep your money. Now let's call this wallet the Bank of Wonders. This bank has a trick. It doesn't keep all your money in the wallet. Instead, it lends some of it out to people who want to do cool things, like start a business or buy a house. You should get the gist by now that this is what we call fractional reserve banking. Let's talk about the good stuff. Increased money supply. Because the Bank of Wonders lends out some money, more people can borrow and do exciting stuff like starting a bakery, opening a new shop, or buying a home. It's like spreading the financial magic around, allowing banks to create a larger money supply than the actual amount of reserves. This can contribute to economic growth and provide liquidity to the financial system. Interest income. When the bank lends money, it asks for a bit more in return. That's the interest. Just like when you lend a friend a few bucks and they give you back a bit extra for your kindness. This interest income is a significant source of revenue for banks. Economic stimulation. This sharing and lending create a buzz in the town. Businesses grow, people buy more things, and it's like the town is living its best financial life, like a blockbuster economic movie. Everyone wins. Now let's talk about the downsides. Systemic risk. Imagine if everyone in town suddenly wanted to take out all their money from the Bank of Wonders. That might be tricky because the bank doesn't keep all the money in the wallet. This situation is what we'd call a bit of a financial frenzy, or a bank run, which is when depositors lose confidence in a bank's ability to meet withdrawal requests. This can lead to a self-fulfilling panic and threaten the stability of the banking system. Keeping the money puzzle intact. Lending out too much money can be like solving a puzzle with missing pieces. It can get a bit confusing to keep everything organized and ensure the puzzle looks right. This puzzle brings a layer of complexity to the financial realm, and to navigate this complexity, we rely on solid regulatory frameworks. That's where the lawmakers come in. Think of it as the playbook that guides the game. Without it, things could get a bit chaotic, potentially leading to financial turbulence. So, having strong regulations is like a safety net, preventing us from stumbling into a financial crisis. It's the backbone that keeps our financial system steady and secure. Not everyone gets the same financial experience. While some people get to enjoy the benefits of borrowing money, others might not get as much as they need. It's like some people getting front row seats in the financial show, while others are a bit farther back. Some argue that the system can exacerbate income inequality by favoring those with access to credit. Finding the balance. So the Bank of Wonders and the townsfolk need to find a balance. They want to share the financial joy, but also make sure things don't get too crazy. It's like a financial dance where everyone needs to be in sync to keep the town's economic music playing smoothly. This is why the reserve ratio changes frequently. World's Reserve Requirement Ratio. The moment we've all been waiting for, who has unlocked the infinite money glitch by loaning out everything in the bank, keeping nothing, and still managing to earn interest on it? First, let's explore which country has the strictest requirement. Leading the charts is Venezuela, with a requirement of 73% as of October 2023. Following not too far behind is Argentina at 42%, and Mozambique is next in line at 39%. Feel free to leave a comment below if you'd like us to delve deeper into their economies, especially considering their strict reserve requirements. Now let's address the intriguing question: who holds the key to the infinite money glitch? You might be surprised to learn that it's not just one country. There are several nations with no reserve requirements. You might find it interesting, or perhaps not surprising, that America operates with 0% reserve requirements. Since March 26, 2020, the Board of Governors of the Federal Reserve System, responding to the COVID-19 pandemic, has maintained this policy, and it remains at 0% as of now. Now, who else is in on this intriguing infinite money system? Morocco and Kosovo join the list of countries with no reserve ratio. Not far behind is Japan with 0.8%, which, in our opinion, is pretty close to zero. Conclusion. There you have it. We've unraveled the infinite money glitch of banking, focusing on the intriguing world of fractional reserve banking. This system plays a pivotal role in our economy, influencing everything from loan availability to financial stability. I hope you enjoyed today's topic. Join us next time on the Triple E Show for more insights into the dynamic world of economics, engineering, and energy. Don't forget to like, subscribe, and share your thoughts in the comments.